Takes us to our talk of the tape, which is all about the rally, obviously. Is it running out of steam, as some now suggest? We're just taking a momentary breather, but no real breather at this moment as we come on the air. Let's ask Gabriela Santos, Chief Market Strategist for JPMorgan Asset Management, with me at Post 9 once again. Welcome back.
Thank you.
I have to say, reading through your notes, you sound really positive on this market.
We do sound positive. First, on the fundamentals. For the economy, we see growth normalizing this year, 2%, but zero recession in our base case. We see inflation also moderating towards 2% by the end of the year. So you still have a pretty resilient nominal growth backdrop for companies. So resilient revenue growth at the same time that it seems to us that the big takeaway from fourth quarter earnings was a bottoming in the margin contraction from last year.
I mean, I read through the notes here. I mean, you sort of hesitated for a second where I said you seem pretty positive, but you do say positive trend for stocks should continue. Fundamentals point to further gains. You use the word sweet spot at the overall level. Expect equity multiples to stay elevated. That's somebody who's pretty positive on this market.
I hesitate when we say very positive, just because I want to.
Sorry for using the word very.
No. We are positive. I just want to clarify some nuances beneath the surface. I think when we speak about the fundamental backdrop, it is supportive, but there are pockets of important normalization here. We're not talking about re-accelerating above trend kind of economic growth. We're also not talking about a very swift return to normal interest rates. So things that are really tied to nominal GDP or to rate cuts are not the environment we want to be focused on.
Okay. Today's CPI really did nothing to upset the story.
Yeah.
It's not like we expected anything in March anyway.
No.
And now there's a bunch of data still going to come around before June, when the market still is placing that big bet that you're going to get the first cut. Is that how you see it?
That's right. I mean, it really didn't change the narrative. If you were bullish on inflation or bearish on inflation, you took away the same conclusion you came into the report with. Ultimately, for us, I mean, if you actually take it out to 2 decimal points, CPI beat by very little. It increased 0.36%. So it wasn't a hot 0.4%. And it's still the same remaining inflationary pressures of shelter and auto insurance. People forget auto insurance is adding 0.6 percentage points on its own. So it doesn't change the narrative. These are lagged measures. We do expect inflation to continue normalizing. And it's really nice that we had already taken out 3.5 rate cuts since mid-January. And now the market is completely aligned with the Fed dots. So if there was any doubt, June is really the earliest for cuts, but still very much on the table. What
do you make of what some suggest is now the changing makeup of this rally? One that was led primarily by NASDAQ, large cap growth stocks. Maybe that's changing a bit. Maybe it's changing a bit even within that space of large cap tech.
It is changing quite a bit, and I think it's actually a healthy sign. For example, within mega cap tech, the Magnificent Seven that dominated so much of returns last year, there was dispersion within the group, but they were all up. This year, you're seeing quite substantial dispersion within the group. Some are up double digits, some are performing in line with the market, and some are down double digits. That's very healthy to see, thinking of the actual companies as individuals. You're also seeing other parts of the tech sector participate and other sectors. Things like healthcare, which we had talked a lot about last year as being one of our favorite sectors, contributing as well. So I think it's a very healthy appreciation that it's not just AI, it's not just about the initial beneficiaries of that theme, it's also about resilient earnings.
At the same time, you suggest it's perhaps too early to invest in areas of the market that need rate cuts.
Yeah.
Now, if there's one sector today that you look at, or one index, the Russell is red.
Yeah.
No big shock, because if, CPI still reflects that inflation to some degree is maybe a little stickier than people think, or it keeps rates at least a little elevated. That space is probably not going to work well in that environment. Is that a fair assumption?
That's right. I think if your investment thesis is purely dependent on substantial rate cuts as the catalyst, it's still too early for that. The time will come, but it's still too early. And the place to really express that view is, for example, size, so a preference for large or mid cap versus small cap. And it's even within sectors. So, for example, it's quite impressive over the past year since the SVB crisis a year ago that regional banks are down 10%, while the large cap banks are up 14% and the broader market is up 22%. So it's nice to see that differentiation in size, but also within sector.